to splintered sunlight, inch your way through dead dreams to another land. Maybe you're tired and broken, your tongue is twisted with words half spoken, their thoughts unreal. What do you want me to do for you, to see you through? A box of rain will ease the pain, and love will see you through.
Good evening, and welcome to another edition of Bond Squad After Hours. This is the June 24th, 2015 show. As always, our disclaimer, Bond Squad and Wealth Strategies and Management are separate entities from Private Advisor Group. Private Advisor Group is a registered investment advisor and is our registered investment advisor. Well, good evening. We're broadcasting you from the great outdoors at the Bond Squad Lodge, deep within the woods of Northeast Pennsylvania in the Pocono Mountains. Why not? It is summer. We finally have no rain. More's coming tomorrow and Friday and Saturday and Sunday. So, we'll take advantage of this nice weather. Maybe we'll get lucky. We'll see some wildlife go by. Maybe we won't. So let's discuss the week that was. In our week off, we had the Fed speak last week, and basically it looks like tightening is on hold until at least September. Not surprising. The economic data is kind of mixed. It's not terrible. So all the bulls, the rah-rah boys and girls out there who are saying, oh, the economy's back. No, it's not, at least not back to what it was before. We don't think it can be. It's like this forest here. It's mature, right? So when a forest matured, it's slower growth. When the forest it was bare, if there was a forest fire, the growth springs up very fast. Once it's mature, you don't get that undergrowth. It's more of a gradual situation, right? So that's what's happening with the economy. We don't have the benefit, I hate to say benefit, of rebuilding after World War II, of rebuilding our allies and enemies after World War II, of a baby boom. So now we're more incremental rather than exponential growth. That's not good enough for the people who believe that, the years 1946 to 2006 were normal. As one of our subscribers pointed out, the only other time that you had something similar to that occurrence was after the bubonic plague in Europe in the Middle Ages, where it thinned the population, gave rise to guilds and whatnot. So that wasn't normal per se. What's normal? Normal's in the eyes of the beholder. But to think that we could grow the way we did and build the way we did and have consumption the way we did forever is a bit naive, but nobody wants to admit, no one wants to think that far. Everybody does it. Everybody buys a home, picket fence, 2 cars in the garage, have two or 3 kids, and life goes on. Well, things change, technology changes, spending changes. It's funny because one of our colleagues was looking to do ETF models, and I guess I can say that on the air. And it was by a company, and they changed the allocations based on the business cycle. So if you're early in the business cycle, you tended to be more aggressive than late in the business cycle, where you got more conservative. The problem was, and I noticed this right off the bat, is the companies that this investment company considered consumer discretionary, and to be fair, the industry considers consumer discretionary have almost become consumer staples. And that includes your Starbucks, that includes your, some of your fast casual restaurants, your electronics company. And that's the other thing too, the technology, at the end of the business cycle, they kept looking back the way things were. Oh, at the end of the business cycle, technology is aggressive, you get less aggressive. Yeah, but the technology that they were recommending was Apple, was Intel, was, were the big boys, was Samsung. These are now, in the modern world, this tech might be akin to what industrials were years ago or decades ago. So it used to be what's good for General Motors is good for America. Now it might be what's good for Apple is good for America, or what's good for Samsung is good for the world. what's good for Intel, all the big, larger cap electronic companies. So tech has to be looked differently if you're talking about large tech. So that's just a little venting about how models, when they try to play business cycles, are looking at things differently. Case in point, and before we get on to our real topic tonight, let's consider transportation. Everybody's, what's the matter with the Dow transports? Oil is down. Transports should be doing very well. There's a problem with this. What were transportation companies transporting? Oil or materials used to extract oil and gas, right? When you stop exploring or slow down exploring, you don't need to move that equipment or those materials for fracking. We're producing as much oil and gas we did when prices were higher, but we're not exploring for new wells, and we're not drilling the new wells, even though the rigs set up. We shut the rigs down. So it's hurting that way. Plus, with the stronger dollar, right? Our exports it's more challenging to export. Our goods are more expensive. So you're not transporting that stuff overseas. Meanwhile, consumer spending is not focused on widgets, on gadgets, on baubles. It's on connectivity. It's on electronics, software, streaming, you name it. Right? You don't need to put that on a ship in Thailand or China and bring it here. You just do what I'm doing and you log on, right? So that's where the spending is going, and that's what's kind of baffling people. And we'll segue into GDP on this, and durable goods for that matter. There was such an expectation that lower fuel prices were going to unshackle the consumer. Mr. and Mrs. Smith and Mr. and Mrs. Jones are going to try to keep up with each other by going to Home Depot, by going to Best Buy, by going to various retailers and trying to outdo each other the way it was. The only place that really surfaces is in automobiles, and automobiles might be the new home, the new status symbol. So instead of having to, moving out of your 3,000 square foot McMansion to a 4,000 square foot McMansion to a 5,000, now it's I don't need to buy the Hyundai like I did before. I can buy the GMC or maybe even the BMW if I can lease it, or if I can extend my payments out for 7 or 8 years. Now I'll have the status symbol in my driveway, even if my driveway is part of a rental property. That's my new status symbol, right? So that's how things have changed. So when we look at, even if you look at business cycle models, business cycle investment, we have to see, okay, do we still want to have the same weightings of different sectors, considering that some of these sectors are now different versus the economy? Industrials aren't what they were, and with the strong dollar hurts them. So at the end of a business cycle, instead of moving into industrials for safety, maybe that's the bad part to go. Maybe you want to be in larger cap tech. And I'm thinking more of equities, bonds. We look at credit profile and spreads. As long as the company has a strong enough balance sheet to pay the debt, and you're getting a decent enough spread over treasuries versus duration, and we're fine. We don't need to be that nitpicky as far as diversification, which makes us laugh when you see SMA managers and whatnot use these big models where they have 100 holdings and they have names, issuers repeated 3 or 4 times. And look what a good boy am I. It's really not that difficult, at least not in the investment grade world, to be fair, or in the municipal world for that matter. But this is how the economy has changed, so investment strategy has to change. So that brings us to durable goods. The durable goods data we saw the other day were okay. We saw, a little bit of business spending there, but not a whole lot. And when we look at it, it was up, the way it was expected, but the prior number was revised lower. So that begs the question: did the numbers really come in on target the way it appears at first blush? So we have durable goods X transportation. We take X transportation because aircraft, the biggest component of transportation, or at least the biggest volatile component of transportation, is just that. Nobody places consistent orders for Boeing aircraft per se. They're gonna put an order in for 20 planes, 50 planes, whatever it might be, 1 month. I'm not gonna order that again. They put airlines from around the world will put orders in, and it hits that month. So that's where you'll see durable goods. The headline will be big 1 month, down another, big 1 month, down another, because these big aircraft orders are coming in some months and not others, right? So you back that out. But if you want to look at headline durable goods for May, they were down 1.8%, and the April number was revised down from 0.5% to down 1.5%. That includes transports. But transports was much of that, but not all of that. When we look at durable goods for May, ex transportation, it increased 0.5, which was what the street expected. But the prior data was revised down from positive 0.5 to negative 0.3. So really, you didn't increase all that much. You went up 0.5 from a negative number, right? So you got what, 0.2 net, and you were down. So that durable good number isn't all that hot. We look at capital goods orders. Yeah, they rebounded a bit. They were up 0.4, but the April number was revised from up 1% to down 0.3%. So you were just about flat on capital goods orders. And that's huge because capital goods orders would indicate business spending and investment, and that could increase your productivity, and you get more productive, you become more profitable, maybe you can expand, maybe you hire workers. What we see here is more of a zero-sum game, at least we think, where we become so efficient with automation, robotics, technology, connectivity, that it almost becomes an either-or game. We'll add workers and not invest in technology as long as workers are our cheapest option. But if workers want too high a wage, all right, we'll buy some more equipment. And we were at a dinner last night with Tal Daly from Clearbridge / Legg Mason, and I'm a big fan of Tal Daly. He's another history major. He sees things very clearly, and he's very positive on the economy in the long run, but he's very clear that the new economy will not look like the old economy. Robotics means you can use a third as many workers for the same output, but we can produce that much more. So the net jobs created might be the same. We'll just have more manufacturing again. All right. So you can do that, but the wage pressure will be lower because if labor becomes too expensive, we put the new model of technology in there, and as technology becomes smarter, and we're seeing this with self-driving cars, with artificial intelligence, the ability of technology to do jobs goes further and further up the intellect scale, further and further up the economic scale as far as pay goes. So where at one time it was the GM or Ford worker who was put out of a job by the robot that can put the nut on the bolt, spot weld the seam on a car, and stick the wheels on. Now you're getting to the point where the computer can run the factory, change the assembly line, say build more of this and less of that, and before long the computer is going to be able to design the car. Maybe you get the designer to design the shape of the car, and the computer will figure out the engineering on it. All right, so that moves further and further up, unless, of course, the engineer is willing to, instead of working for $100,000, will work for $60,000. Then might be more cost effective than the computer. And the problem is, once you get the computer in, you can't take a pay cut and get the computer out. Once that cost is sunk, sorry guys, we're not unplugging the computer to pay you again, even though you'll work for less. He's purchased already the computer. So we're seeing the zero-sum game, and we're seeing this reflected in the numbers. Yet they keep pointing to, we had better housing numbers, new home sales. They ran at 546,000, one of the better numbers in a while. The prior number was revised up to 534 from 517, and that's all good. And we're starting to see housing thaw a little bit. The problem is, we should be seeing, even in this economy, somewhere around 1.5 million new homes. We'd be happy to get to a million at this point, and we're not there. We have a backlog of homes, yet there's a shortage of supply of homes, not because they're not there, because people are underwater, they can't sell them. A lot of people love to sell, move to another part of the country, get a better job, get a different lifestyle, better weather, whatever it might be, and they're stuck in their home. They're underwater, or they're flat, or they have too little equity, and they're stuck there. So the housing market is locked. All right, the people who might want to sell can't. And the homes that are available might be too pricey, even at these low rates, for the people who are most likely to buy. So you're kind of stuck there. Meanwhile, rents keep creeping higher and higher, and that's squeezing people to where maybe they're going to have to bite the bullet and pay up if they can. That's a whole other problem. So we're coming to a transition point, and we believe the big sticking point in this is is financial regulations on the banks. Now, we're not defenders of the banks. We saw some of the stuff going on, albeit from a short distance, not a great distance, not up front, from a short distance. How due diligence was kind of thrown out the window in the quest for new collateral for securities. And we understand how that works. We've been in the mortgage around the mortgage-backed industry for what now, 25 years. In fact, when Wertheim Schroeder first started trading mortgages, I adapted the booking system for the trading desk, and that's how I got noticed and became a trader. The late Mike Farrell found Annaly was my boss at the time, or one of my bosses, and that's how I got. So I have a pretty good understanding of mortgage backs, how they work, right? And when we look at the mortgage and the housing market, we don't want to go back to where we were during the housing bubble, but we don't want to be so tight that banks can't take any risk and only can lend to the top tier. So a balance has to be struck, and nobody seems to want to do that. So until that balance is struck, housing, even though it might have strong fundamental demand, it's the wheels of the tires are flat. So we need the regulations to lighten the load, to let those tires pump up. So we're kind of stuck there. And that's and this is reflected in our GDP numbers. Now, today we had the last look, the quote unquote final look at Q1 GDP. And we saw that coming at -0.2, revised upward from -0.7. And right away, the financial television stations were doing cartwheel. See, the economy's back. All right. Never in my, what is it now, 28 years on the street and 25 years in fixed income, have I ever saw people optimistic about a -0.2 GDP print. Okay. Oh, but it's transient. We're gonna grow between 2 and 3 this quarter. Oh yeah. All right, it's transient, meaning temporary, but it's not good. Winter and a strong dollar should not take away all your growth, right? And if this is the rebound, I mean, the Atlanta Fed has their GDP now estimate, and now it's tracking at 2. The street street consensus around 2.5 GDP for Q2. The guys on CNBC think it's closer to 2.9. All right, we're in the 2 to 2.5 camp at this point, or maybe the 1.8 to 2.20 camp, to be more exact, which is good. You're not falling into recession, but did anybody in their right mind, I mean, really seriously, think that we're going to recession because of the negative print in the first quarter? Anybody with half a brain knew that was transient, but anybody with half a brain knows that the real number still has a 2 handles, 2-point-something% growth. And that's probably what we're going to get. So let's say we track at 2, we tracked at 1, that's 1. So we tracked it effectively 0 in the first quarter. So that's going to give you a 1% average for the first half. So what are you going to do in Q3? Well, you probably print 3 to 3.5. Hopefully, you get some inventory build up going into the holidays. But inventory data indicates that many companies are full up on inventory now. So, but will be nice to say you get 3.5. You're not going to see, we don't think, the 5% you saw last year. The snapback isn't that strong. Well, and the contraction wasn't that big either. So where are you going to be for Q4? Probably back in the mid-2s. So you'll average 3 there. So if you average 1 for the first half and 3 for the second half, you're at 2 for the year. And that's probably indicative of where we are. Again, it's a mature economy. We don't think this is bad. We're not doom and gloom. We don't think we're going into a recession, but we don't think we're heading towards this rip-roaring economy. And because of that, everything gets miniaturized, as it were. So if real growth, if trend growth is in the 2s and overheating growth is in the high 2s to 3, where it used to be subpar growth in the 2s and trend was 3, then let's say we knock everything down a good amount. Well, that means, as the Fed's been trying to communicate to everyone, maybe neutral Fed funds is between 2 and 3. Maybe an overshoot Fed funds, what the Fed always does, is 3.5, right? So you're not getting this big move. And inflation, maybe inflation now is structurally 2 or less, which means long-term interest rates might be structurally, especially the 10-year, 3 or less. Excuse me, my neck is a little stiff tonight. I was working in the garage. That's why I have my shirt on. Anyway, America works, manual labor. But But that's everything has to be scaled back. So everybody's worrying, oh my God, we're going to see if Fed funds are at 2, and right now we have the 10-year at 3. It's 270. It's 225 basis points above Fed funds right now, which it is roughly. Well, then that means if you're at 2, you're going to be at 425 or so, or 435 on 10 years. No, the curve doesn't move parallel. It moves flatter and steeper. And usually when the Fed is tightening, the curve flattens. When the Fed is easing, the curve steepens. So even though we saw some steepening recently, the overall trend should be towards a flatter yield curve. And by the way, the yield curve is not steeper than it was this time last year. It was about 10 or 15 basis points steeper last year, and it was steeper in late 2010, early 2011, and steeper in late 09, early 2010, when the Fed put the first 2 rounds of QE where it bought short-term items, it pushed short rates down. That's considered inflationary. You got a steeper curve. That's why the Fed bought the long end to try to push those rates down, get the mortgage benchmarks down. So that's when we had Fed easing, but long rates come down. Usually it's the other way, and then when the Fed tightens, long rates come down. So this idea that seems to be pervading the mutual fund industry, wealth management, financial television, everybody but the bond guys, they keep thinking that all rates have to move parallel. They never have before. That's not the way it works. Why should it do it? It's probably not going to. You might get a short period where they move in tandem, but in general should be a flatter yield curve. So that's where we stand. So we're in the unenviable position of not being liked by anyone. The bears hate us because we don't think we're going to into recession. We don't see deflation, and we don't see, the 10-year going back below 2 or down to 1.5. Right? The bulls hate us because we don't see 3, 4, 5% growth. We don't think that the Fed is going to get behind the curve. Inflation's going to roar, and the bond market's going to sell off, and we're looking at a 4 or 5% 10-year in the next year or two. We don't believe either side is right. We think the answer, as it usually is, in the middle. So you take a little duration, don't go crazy. Take a little credit risk, don't go crazy. It's really simple. And these pundits who come on TV and say, "Oh yeah, but bond prices will go down," and if your bond prices go down, 5% a year, it'll take you a couple years of income at this to make that up. No, it won't. Hold to maturity. You can get par. Only if you have to sell. Only if you're in a bond fund or something, or where somebody is selling and locking in those losses. That's not time you care about that. Get it out of your heads that everything has to be for total return price. You have demographics that are just, and I was talking, and by the way, tonight we were supposed to have Bill Malley on tonight, my old partner, but because he's up in the area on vacation, unfortunately, he's taken ill. Bad cold, nothing serious, but he can't talk. But we were at dinner the other night, and we were saying the same thing, that these pundits don't get it. There's a structural demand for bonds from aging demographics around the world, either directly or indirectly through pensions. Right? There's the demand for it from central banks who need to manage and not manipulate, right, their currencies. There's no shortage of demand for long-dated bonds, especially of your highest quality reserve currency countries, and that's the U.S., Germany, Britain, Japan. Those are the big. China reserve currency. All right, when they can float their currency and no capital controls, free flow back and forth. And maybe we'll consider them for a reserve currency, maybe 10 or 20 or 30 or 40 or 50 years from now. All right, but for the developed countries, there's no shortage of demand for bonds, and as the life expectancy grows, the demand for bonds becomes even greater, especially longer duration. Some of the equity geeks say, "Oh yeah, that means people will have to buy stocks longer, in their lifetime than they would have before." So where a portfolio was mostly bonds by 65, maybe it's still balanced up to age 75. The problem with that very flawed theory is that would work if these people were working that long. Just because you live longer doesn't mean you're able to work and replace any investment losses longer. So there's the bird again. We had him last time we were outside. He must not like us. He must be a socialist or something. I don't know. But he's back. So what we think is that not only will fixed income be in demand, but longer duration bonds will be in greater demand because retirees now have to try to fund their retirement and provide income longer. Remember, you live longer, but you don't necessarily work longer. You're not at working age. So diseases that used to kill you just debilitate you, prevent you from working, but you're alive. So you have to fund that somehow. And you need income. You can't afford to lose it. You can't replace it. Right? So that's where we think we're going with this. It doesn't mean you abandon stocks, but maybe you go up in quality. And I want my blue chips, my dividend pays, not necessarily utilities because they're bond-like, right? And people can't figure that out very well either, but that's another story. So we can move on now to Greece. Well, here's Greece in a nutshell. It's a disaster, okay? Greece is trying to come to an agreement with the ECB, the IMF, the various European officials from the sovereign nations, their finance ministers. And the problem is Greece is trying to find a way to basically keep the status quo and give token concessions. Meanwhile, the Europeans are like, look, you got to make structural changes. And the Greeks are like, well, that's not fair because we don't want to have to make those changes. How about we give you this? And it's kind of appropriate that type of attitude is coming from the Greeks, because if you read Greek mythology, it's filled with these mythological subjects trying to fool the gods by giving them ostensibly what they asked for, but not what they really asked for, right? And they try to trick the gods. And in the end, the gods aren't tricked, and the person of the story in the story gets punished somehow, turned into something, killed, banished, whatever it might be. And the Greeks to try to do that again to the gods, who are part of the EMU, and the EMU is not having any of it. Do we think they get a deal? They'll get something done. Will it happen by June 30th? Probably not. It's something will be kicked down the road. Will the deal mean much? No. We think that this is just, like a chronic disease. It's never going to be cured, but it's never going to kill the patient. And Greece will just be an albatross, a leech upon the European Monetary Union forever. And as long as Greece is doing that, there's always the specter that Italy, Portugal, Spain, and to a lesser extent Ireland does the same thing. Hey, we don't want to make reforms either the way you want us to, so let's give you some token concessions we can go along. So, there's a consensus opinion that in the second quarter, the Eurozone could see 2% GDP. But we think that might be a flash in the pan type of thing on the backs of the stimulus, the way it keeps happening in Japan, and then growth peters out, and they have to put more stimulus, and then it goes up well, and growth peters out, and they go to QE and mega QE and buying of equities. So we think that's what Europe is basically. Their population growth turned negative. U.S. population growth increased by 1.4%. The birth rate increased by 1.4%. Still far below what it was during the baby boom. Still far below what it was in the 1980s. Still even below what it was in the early 2000s, but it got a little bit better. Will it go back to those other numbers? Probably not. Going back to the baby boom numbers is almost certainly not going to happen. But could we go back to somewhere in the 2000s? It's possible, but it still not going to engender the type of growth that we've become accustomed to, or to which we become accustomed. Can't let that partisan dangle out there. So that's what we're seeing here. All right. And we don't think people are getting that. And they're too busy waiting for a return to prior conditions. We're not returning. History, as Mark Twain says, doesn't repeat, it rhymes. So we see rhymes, we see recoveries, we see industries do better, we see asset classes do better, but they don't perform exactly the same. So if you're using a model that's predicated on playing business cycles the way before, playing consumer spending habits the way they were before, playing industry development the way it was before, it's probably not going to, or interest rates even, probably not going to happen. Because to get that, you have to recreate all the conditions around it, like in a lab, right? If you want to validate the results of an experiment, you have to recreate all the conditions exactly as they were each time. Then, if you get the same result, you can say that the results are valid. We're not doing that. So again, we think that we are stuck in this between 2 and 3% growth structurally. If everything falls the right way in a year, good weather, no wars, whatever, maybe we can print above 3. If we have a bad weather or a disaster or some other exogenous event, there's going to be a quarter or two that we print well below trend. And that's where we are. Does it sound like Larry Summers and Mohammed El-Arian's secular stagnation / new normal? Yeah, it does. But we think that new normal is a better description, not secular stagnation. Not that Mr. Summers is wrong. We do believe he's right, that structural growth is slower, but we don't think it's necessarily a bad thing. Could it be better? Yes, with better fiscal policy that favors more business creation and business risk. Yeah, you probably can do a little bit better. Maybe you get back close to 3 again. On average. But then the Fed raises rates and keeps you down. So to get that 3%, rates might have to stay very low, even with better fiscal policy. But we think that's the norm. We think we are in a new normal. It's not a bad thing. And if you want to get better growth in the new normal, you can't have the same old fiscal policies, right? So fiscal policies have to be different. If we have changing demographics, changing technology, changing consumer preferences, and fiscal policies and tax policies and business policies through the Labor Department stay the same or go backwards towards the 70s and 60s and whatnot, how can you have that type of growth? You can't do it. And so the idea that we had higher tax rates and we had great growth in decades past, different economy. We were the only industrial economy left standing outside of the Soviet Union. They weren't exactly trading with the world. We had a baby boom going on. We had population growth out the wazoo, and you were going to grow in spite of yourself at that point. Now it's more back to normal. The new normal is probably really the old normal, and the years from 46 to 06 were probably the abnormal. So, with that, we're still constructive on the equity markets, on the bond markets. We are worried about the bottom of the junk bond market. There's been more cracks. There's defaults have been picking up there even before the Fed moved rates higher. Remember, rates 5 and out have moved higher. So that's hurting these companies without the Fed doing anything. And it's starting to show up. Not everything is based on the Fed tightening. The bond market can do it itself, especially 5 years and out, even 3 years and out. So we're starting to see that. So we hold very few bonds in any of our portfolios in which we have authority. Below triple C. In fact, there's only below single B. In fact, there's only one issuer, and that wasn't triple C when we bought it. And we think that's the downgrade was overdone on that. Call us if you want to know the name. I don't want to broadcast it, give blanket recommendations. That wouldn't be right. But outside of that, we're trying to stay even in high yield. Where suitable, double B paper for the most part, in investment grade, triple B to single A munis. The opportunity of a lifetime. People are so afraid of munis. These pundits and even some of the investment strategies that people scared, where they're running out of munis into junk paper. I know you're scared that your portfolio that's managed elsewhere might have Puerto Rico in it. Don't manage it elsewhere, or have bonds go out and manage it. We won't put you in Puerto Rico unless you ask for it. Right? State specific means state specific where we come from. But just settle in for the summer. There's going to be some volatility out there. You're going to hear a lot of noise. There'll be a lot of theories going back and forth, especially while in flux between Fed meetings and a lot of uncertainty out there. Just stick to your core strategies. Don't invest based on the past. You financial advisors who are watching this know better than I do that past performances are not indicative of future results. So why should past models be appropriate now? We have to think for the present and think for the future and use the past as a guide. And as a guide only. And we have to be nimble and think on our feet. If you can't do that, you're going to probably get hammered because the models don't change themselves. It takes people who are vigilant to change the models. And if they're fully confident in the model, they're going to sit back and say, we got the model right. They're probably going to get smacked at some point. Okay? But that's all we have for tonight. We ran a little long tonight. We're in a good mood out here tonight. And it's about 70 degrees, maybe not even. Not a cloud in the sky. The birds shut up. So with that, and remember, all the problems out there, it's just a box of rain.
Just a box of rain, wind and water. Believe it if you need it. If if you don't just pass it on.